In the stock market, there's this deadline that's way more powerful than any earnings report or flashy headline. And it's not based on speculation. Nope. It's written right into the very code of the market. And once you understand it, you start to see one of the most predictable and potent forces on all of Wall Street. And look, this deadline isn't about guesswork. It's all about ownership. It draws this really clear line in the sand between the tourists just passing through a stock and the residents who are in it for the long haul. Crossing this line, well, it determines whether you get a direct cash payment from the company or if you get nothing at all. Let's break down exactly how this whole mechanical process works. All right, so to really get this, we've got to peek behind the curtain into what you could call the market's hidden plumbing. See, when you click buy, you don't actually become an official owner that very second. There's this tiny delay called the settlement cycle. And that small delay, that's the key to this entire phenomenon. So here in the US, trades settle in just one business day. Wall Street has a name for it, of course, T+1. All it means is that the official ownership transfer happens one day after you make the trade. This simple, kind of boring rule drives literally everything we're about to see. Okay, let's make this real. Let's walk through an example. Let's say a company sets its record date for a Wednesday. That's the day they check their official list of shareholders. Now, to be on that list, your trade has to be settled. And because of that T+1 rule, you have to buy the stock no later than Monday to make the cut. Monday becomes the absolute final deadline. Okay, so what about Tuesday? Well, that's the ex-dividend date. And X, it literally just means without. If you buy the stock on Tuesday or any day after, you get the stock, sure, but you get it without the right to that dividend payment. You're too late. The seller gets the cash, not you. And this simple rule sets the stage for a huge collision in the market. And this simple timeline, it sets up this incredible high-stakes drama with two completely opposing forces, both on a collision course. So on one side of the battlefield, you've got this massive automated army of buyers. They're driven by something called a DRIP, which stands for Dividend Reinvestment Plan. It's just a simple instruction you give your broker that says, hey, instead of sending me cash for my dividends, just automatically use them to buy me more shares of the stock. It turns these little cash payments into a seriously powerful compounding machine. And you gotta understand, the scale here is just massive. For a lot of big popular stocks, the huge majority of shareholders have these drips turned on. What makes this so powerful is that the buying is totally robotic. The computers running these things aren't looking for a bargain. They have one simple command, buy. That's it. When millions of dollars in market orders all hit at once, it's like a giant vacuum cleaner just sucking up every available share. All right, so that's one force. Now let's talk about the other one, the investors betting against the stock. The short sellers. For them, this dividend deadline creates a really big problem. It's a trap, really. See, when you short a stock, you're borrowing it from a long-term owner. But that original owner, they still expect to get their dividend check. So who pays? The short seller does. That dividend amount is literally pulled right out of their account. Ouch. So here it is. This is the collision course. You have two totally different groups, both buying the same stock, but for completely opposite reasons. You've got the accumulators, the drip investors, buying to compound their wealth. And then you have the escape artists, the short sellers, buying to escape paying that dividend. They see that bill coming and realize, hey, it's cheaper to just buy the stock back and close out my bet. So you've got this one group rushing to get in before the deadline and another group desperately trying to get out of their short positions. And when they all slam into the market at the same time, you get what's called the pre-dividend squeeze. I mean, just think about it for a second. Income investors are buying to capture the dividend payment. At the exact same time, short sellers are buying to escape having to pay it. Two completely different groups are just flooding the market with buy orders, all at once. It's a perfect storm of demand. Okay, so let's break down exactly how this squeeze plays out, step by step. First, anyone who actually wants the dividend, well, they're not selling, right? So the supply of available shares just dries up. Then you get two huge waves of buyers, the income hunters and the fleeing shorts, hitting the market at the same time. With a giant mob of buyers and very few sellers, the price has almost nowhere to go but up. And this is the absolute key, right? This isn't happening because of some big news story or an earnings beat or some hot new product. It is a purely mechanical lift in the stock's price. It's driven entirely by the rules of the market's plumbing and the deadlines we just walked through. But this whole thing is about so much more than just a short-term price pop. Getting a dividend actually has this really profound psychological effect. It completely changes your relationship with a company. Think about it. When that cash actually hits your account or those new shares just appear, suddenly that company isn't just a ticker symbol on a screen anymore. It's a real asset generating a real return for you. This creates what they call stickiness. Investors who get dividends are statistically way less likely to sell, which creates a really stable and loyal base of owners. You've probably heard that famous quote attributed to Einstein, right? It perfectly describes what's going on here. The drip investors, the ones reinvesting their dividends, they are the ones earning compound interest. And the short sellers? Well, they're the ones paying it, right out of their own pockets. And man, this is where the long-term magic really kicks in. Just imagine this for a second. Say you buy a stock for $30. Right now, the dividend might be pretty small. But what if that company grows, and over the years, that annual dividend grows to $10 a share? Your yield on cost, that's the return on your original $30 investment, is now a massive 33% every single year. That's the incredible power of compounding dividends. And finally, and this is so important, a company doesn't just pay a dividend by accident. It is a deliberate, powerful signal to the entire market about its financial health and about its confidence in the future. I mean, here's the bottom line. It's as simple as this. You can't fake a dividend. A company can play all sorts of games with its accounting, but sending cold, hard cash to millions of shareholders, that requires real, actual profit. A dividend is the ultimate audit. It's proof that a business is the real deal. So what's the big takeaway here? We spend so much of our time focused on the daily headlines and all the earnings drama, but maybe, just maybe, the most powerful forces in the market are the quiet, predictable ones, the ones operating deep down in its plumbing, all set in motion by the simple deadline of a dividend payment.